The biggest lie in modern finance is the idea that earning average market returns automatically leads to an average life. In reality, the market's long-term average already represents the collective success of the entire economy. Capturing that growth consistently puts an investor ahead of most participants, not in the middle. The illusion comes from confusing simplicity with weakness, when the data shows otherwise. Decades of research prove that broad market returns outperform the majority of professional fund managers after costs. This is not opinion, it is arithmetic. When thousands of highly paid analysts compete over the same information, their results cluster around the market average. Once fees are subtracted, most active strategies fall behind what the market delivers for free. Many investors unknowingly pay high fees for the privilege of underperforming the very market they are trying to beat. Expense ratios, trading costs, and hidden turnover taxes quietly drain returns every single year. These costs may look small on paper, but over time they compound in reverse, working against your wealth with relentless mathematical certainty. Beating the market consistently requires an information advantage that most individuals simply do not have. Institutional traders operate with faster data, superior tools, and entire teams dedicated to analysis. Competing without that edge is not confidence. It is speculation. For most investors, the belief they can outsmart the market is based on hope rather than probability. Index funds are often misunderstood as settling for mediocrity, when in reality, they capture total economic growth. They do not aim to win individual battles, they aim to win the war of time and compounding. By owning the entire market, you remove the need to predict which companies will succeed and which will fail. The mathematical probability of selecting winning stocks consistently over decades is near zero for the average investor. Even professionals struggle to repeat success across different market cycles. Luck dominates short periods, while skill is difficult to isolate. Indexing accepts this reality and aligns with statistics instead of fighting them. Active management fees may look insignificant in a single year, but across decades they create enormous opportunity costs. A small annual drag compounds into years of lost progress. The market rewards patience, not constant activity. Reducing unnecessary friction allows compounding to work at full strength in your favor. At its core, indexing is not speculation, it is probability maximization. It accepts uncertainty and uses it as an advantage rather than a threat. Instead of betting on stories or forecasts, it relies on long-term economic expansion. This approach does not promise excitement, but it offers something far more valuable: reliability. An index fund is best understood as a structured basket of stocks designed to mirror a specific market benchmark. Instead of selecting companies based on opinions or forecasts, it simply follows clear rules. These rules define which companies belong in the market and how much weight each one carries. The result is an investment vehicle that reflects the economy as it actually exists, not as someone predicts it will become. The most immediate advantage of this structure is instant diversification. With a single purchase, an investor gains exposure to hundreds or even thousands of companies across multiple industries. This dramatically reduces the risk tied to any single business failure. Diversification is not about eliminating risk entirely, it is about preventing one bad outcome from permanently damaging long-term wealth. Unlike actively managed funds, index funds rely on a passive structure rather than human decision-making. There are no managers making emotional calls or reacting to short-term headlines. The fund follows predefined rules consistently, regardless of market noise. This removes behavioral errors that often hurt performance during periods of fear or excessive optimism. Companies inside an index are weighted according to their total market value. Larger companies naturally take up more space, while smaller companies occupy less. This weighting reflects how much influence each company has within the broader economy. As businesses grow or shrink, their position in the index adjusts automatically without requiring investor intervention. One of the most powerful features of an index is that it is self-cleansing. Companies that fail, decline, or lose relevance are gradually removed. They are replaced by stronger and more competitive businesses. This process happens quietly and continuously, ensuring the fund always represents the current leaders of the economy rather than clinging to past success stories. At the same time, successful companies that innovate and expand naturally become a larger part of the fund. Investors do not need to identify winners in advance. The index increases exposure to success as it happens. Over time, this mechanism ensures that growth is captured systematically instead of through guesswork. Because the fund owns the market as a whole, investors always hold the winners of the economy. Some individual stocks will fail, but others will outperform dramatically. The index does not need perfection. It only needs progress. Economic growth, not prediction accuracy, becomes the primary driver of returns. The passive nature of index funds keeps operating costs extremely low. There is minimal trading, no expensive research teams, and limited administrative complexity. Lower expense ratios mean more of the market's return stays in the investor's pocket. Over long time horizons, this cost advantage compounds into a meaningful difference in total wealth. Active management fees may look insignificant in a single year, but across decades they create enormous opportunity costs. A small annual drag compounds into years of lost progress. The market rewards patience, not constant activity. Reducing unnecessary friction allows compounding to work at full strength in your favor. At its core, indexing is not speculation. It is probability maximization. It accepts uncertainty and uses it as an advantage rather than a threat. Instead of betting on stories or forecasts, it relies on long-term economic expansion. This approach does not promise excitement, but it offers something far more valuable: reliability. The pursuit of market outperformance is fundamentally a zero-sum game before costs are even considered. The market itself is simply the aggregate result of all participants combined. When one investor outperforms, another must underperform by the same amount. This reality makes consistent outperformance extremely rare, especially once real-world frictions are added to the equation. For every active trader who beats the market in a given period, there is someone else on the opposite side of that trade who loses. This is not a theory, it is structural math. Trading profits do not appear out of thin air, they are transferred between participants. Once fees and taxes are included, the average active investor must fall behind the market return. When you combine all investors together, the total return they earn equals the market return minus costs. This includes management fees, transaction expenses, bid-ask spreads, and tax inefficiencies. The more activity involved, the higher these costs become. The aggregate result is unavoidable, and it works against active strategies as a group. Index funds remove this disadvantage by guaranteeing the gross market return with only minimal fee reduction. They do not promise to outperform, but they ensure the investor receives what the market actually delivers. By eliminating unnecessary costs, indexing captures the most reliable component of investing: long-term economic growth. Compounding works most effectively when friction costs are reduced as much as possible. Even small annual expenses interrupt the exponential growth curve over time. The difference between low and high costs may appear trivial in the short run, but across decades it can represent years of lost compounding. Efficiency is not exciting, but it is powerful. A difference of a few tenths of a percent in expense ratios can create massive wealth gaps over 20 years. This effect is often underestimated because humans think linearly while compounding behaves exponentially. Index investing aligns with this mathematical reality by keeping costs consistently low year after year. Predicting which active manager will outperform in the future is statistically close to impossible. Success tends to rotate randomly among managers across different market cycles. By the time a track record looks impressive, it often reflects past conditions that no longer exist. Selection based on recent performance is more guesswork than strategy. Historical data shows that past performance of active funds has little to no correlation with future results. What appears to be skill is frequently explained by chance. Index funds accept this uncertainty and avoid the prediction problem entirely. Instead of chasing winners, they focus on capturing the only return that can be reliably expected: the market itself. The hardest part of index investing is not choosing the fund, it is mastering the psychology of doing nothing. Human instincts evolved for action, not patience. When markets move sharply, the urge to respond feels rational, even necessary. Yet the evidence shows that restraint, not reaction, is what preserves long-term returns. Many investors confuse complexity with sophistication and mistake constant activity for intelligence. Elaborate strategies feel productive, while simplicity feels naive. In investing, this intuition is backward. Complexity often increases the chance of error, while simple rules reduce behavioral mistakes. The market does not reward effort, it rewards discipline. Boredom is not a flaw in an investment strategy. It is a feature. A plan that rarely demands attention is often doing exactly what it should. Excitement usually signals speculation, not progress. Index investing removes drama by design, allowing compounding to work quietly in the background without interference. The urge to tinker with a portfolio is one of the most destructive behaviors during periods of volatility. Selling after declines and buying after rallies feels emotionally justified, but it locks in losses and reduces future gains. Index strategies fail not because of structure, but because investors abandon them at the worst possible moments. Index investors must accept that they will never have impressive stories to tell at social gatherings. There are no bragging rights for owning the market. This absence of status can feel uncomfortable in a culture that celebrates bold predictions. Rational investing requires prioritizing results over recognition. Fear of missing out pushes people toward trends, hot sectors, and short-term narratives. These distractions create unnecessary turnover and regret. The index investor understands that missing temporary excitement is the price paid for long-term consistency. Avoiding noise is not passive, it is intentional. Automating contributions is one of the most effective ways to reduce emotional decision-making. Regular investments remove the temptation to time the market based on headlines or feelings. This approach transforms investing from a series of stressful decisions into a repeatable process that runs regardless of market conditions. Over time, consistency proves far more important than attempting to find the perfect entry point. Markets reward duration, not precision. By staying invested and maintaining a steady approach, index investors allow probability to work in their favor. The real edge is not timing, it is persistence. Index funds provide broad market exposure, but they do not eliminate market risk. When the market rises, you participate fully, and when it falls, you experience the decline as well. There is no protective shield built into the structure. Indexing is not a strategy for avoiding downturns. It is a strategy for surviving them over long periods of time. Investors in index funds must accept that they will be present during every recession and every market crash. There is no manager stepping aside or moving to cash at the right moment. This can feel uncomfortable, especially during sharp declines. However, history shows that avoiding downturns consistently is far more difficult than enduring them patiently. Diversification protects against the failure of individual companies, but it does not prevent losses during systemic market collapses. When entire economies contract, most assets decline together. Index funds spread risk across businesses, not across economic cycles. Understanding this limitation is essential for setting realistic expectations and avoiding panic during widespread sell-offs. Cap-weighted indices can also become heavily concentrated in sectors that experience exceptional success. When one industry dominates economic growth, it naturally occupies a larger share of the index. This concentration reflects reality, not design flaws. Still, investors should recognize that diversification does not always mean equal exposure across sectors at all times. Market returns are based on historical averages and are never guaranteed in the short term. Long periods of underperformance are not only possible, they are inevitable. Index investing works because of long-term trends, not yearly outcomes. Anyone expecting smooth results over short horizons misunderstands the nature of markets. This strategy requires a time horizon measured in decades, not years. The benefits of indexing emerge slowly and compound gradually. Short-term thinking turns temporary declines into permanent mistakes. Investors who cannot commit to long horizons risk abandoning the strategy before its advantages have time to materialize. Inflation remains a persistent threat that can erode real returns during periods of economic stagnation. While equities historically outpace inflation, this relationship is uneven across time. Index funds protect purchasing power over the long run, but they cannot guarantee real growth during every economic environment. Patience remains a necessary component. Blindly buying index funds without assessing personal risk tolerance can be dangerous. Market volatility affects individuals differently, depending on income, stability, time horizon, and emotional resilience. A rational strategy aligns exposure with the ability to endure downturns. Index funds are powerful tools, but only when used within a thoughtfully constructed plan. Total stock market funds provide slightly broader diversification than an S&P 500 fund by including mid- and small-sized companies. This expanded coverage captures a wider slice of economic activity. While large companies drive much of the growth, smaller firms contribute innovation and long-term upside. The difference is subtle, but it reflects a more complete representation of the market. International index funds add exposure to economies outside the United States, reducing dependence on a single country's performance. Global diversification spreads risk across different political systems, currencies, and growth cycles. No nation dominates forever, and future winners are difficult to predict. Holding international markets acknowledges this uncertainty instead of ignoring it. Bond index funds play a different role within a portfolio by acting as a volatility dampener rather than a growth engine. They tend to fluctuate less than stocks and provide stability during equity downturns. This balance helps investors stay invested when markets become turbulent. Bonds are not about maximizing returns, they are about managing behavior and risk. Exchange-traded funds are often more tax-efficient in taxable brokerage accounts due to their structural design. Lower capital gain distributions reduce annual tax drag. This efficiency allows more capital to remain invested and continue compounding. Over long horizons, improved tax treatment can meaningfully enhance after-tax outcomes. Mutual funds, on the other hand, offer advantages for automated investing using exact dollar amounts. They simplify recurring contributions and reduce idle cash. For investors prioritizing consistency over flexibility, this convenience matters. The choice between ETFs and mutual funds is often about mechanics, not expected returns. Rebalancing between asset classes enforces a disciplined buy low and sell high behavior without emotional decision-making. When one asset grows faster, trimming it and adding to underperforming areas restores balance. This process maintains risk levels over time. Rebalancing turns volatility from a threat into a structured opportunity. Expense ratios should remain extremely low for core portfolio holdings, ideally under 10 basis points. Costs are one of the few variables investors can directly control. Keeping fees minimal ensures that the majority of returns come from market performance rather than being absorbed by intermediaries. Efficiency compounds quietly but powerfully. Asset location also matters for minimizing tax drag on dividends and capital gains. Placing tax-inefficient assets in tax-advantaged accounts can improve long-term outcomes. This optimization does not increase returns, but it preserves more of them. Thoughtful structure enhances the effectiveness of an already rational strategy. Your savings rate has a far greater impact on total wealth than the difference between good and great investment returns. A high return on a small base produces limited results, while consistent saving creates momentum. Index funds amplify what you contribute, but they cannot compensate for a lack of input. Wealth building begins with behavior, not optimization. Index funds are simply the vessel used to preserve and grow purchasing power over time. They are not a shortcut to wealth, and they do not create income by themselves. Their role is to convert disciplined saving into long-term growth that keeps pace with the economy. Without consistent contributions, even the best investment vehicle remains underutilized. One of the greatest advantages of this strategy is the mental freedom it provides. By removing constant monitoring and decision-making, attention can shift toward increasing income and improving career leverage. Effort spent chasing marginal investment gains often produces less impact than effort spent expanding earning capacity. Indexing supports focus rather than distraction. Financial independence is ultimately a math problem, not a lottery ticket. It depends on the relationship between income, spending, savings, and time. Index funds provide predictable exposure to growth, allowing planning based on probability rather than hope. This clarity replaces speculation with structure and reduces reliance on luck. Time in the market remains the most powerful driver of exponential growth. Compounding accelerates slowly at first, then becomes increasingly visible over long periods. Missing early years cannot be easily recovered later. Starting sooner matters more than selecting the perfect fund or entry point. Duration consistently beats precision. Avoiding large mistakes contributes more to long-term success than discovering the next big winner. Panic selling, excessive leverage, and frequent strategy changes create permanent damage. Index investing minimizes these risks by reducing the number of decisions required. Stability protects progress when emotions threaten to interfere. A boring investment plan often proves to be the most rational path to wealth. Predictability allows habits to form and discipline to remain intact. Excitement fades quickly, but consistency compounds endlessly. The absence of drama is not a weakness. It is a signal that the system is functioning as intended. The most effective action is starting immediately and allowing compounding to operate without interruption. Waiting for perfect conditions delays progress and increases regret. Markets reward participation over prediction. By committing early and staying consistent, investors give probability and time the opportunity to do the heavy lifting.